US Fed in its March meet had defined yet again that it would be patient in changing policy rate. Fed keeps its accommodative stance and scales back policy rate projection, implying no rate hike in 2019. Let's do a three-point analysis of the reasons given by the Fed for not hiking rates and what does it mean for India and other countries. 1. What's keeping Fed from raising the interest rates? Well, given the global economic worries and muted inflation pressures, US Fed has indicated that there is no need to hurry on the hiking of interest rates. Fed has given a temporal definition of patience. Financial projections suggest that there would not be a rate hike this year. Same time, Jerome Powell stipulated that Fed policy rate is at a level where it neither stimulates nor restrains economic growth by changing its interest rate policy. Now, compared to December 2018, there has been a sharp downward shift in the projections for the federal funds rate. Policy rate projection for 2019 is now 2.4%, which is a 50 basis points downward shift in 3 months. Same time, expectation for 2020 and 2021 settles at 2.6%. which implies a solo rate hike in this interest rate cycle. 2. What is Fed's growth assessment and stance on the balance sheet unwinding? Fed observes that economic growth activity has slowed from Q4 CY18 mainly in terms of moderation in household spending and business fixed investments. Now, GDP growth for 2019 is expected to be 2.1% versus 2.3% earlier. Having said that, labor market remains strong. Further, headline inflation has declined largely on account of lower energy prices. Interestingly, there has been increasing deliberation around the stance for balance sheet unwinding as well. With this meeting, stance has officially changed from an autopilot unwinding of balance sheet to a case that unwinding would halt by September 2019. Now, this means Fed would keep the balance sheet size at elevated levels, but revised run rate of unwinding Fed's balance sheet should stabilize around $3.7 trillion. 3. What are the implications of all of this? Firstly, downward shift in policy rate is not a sudden measure. Fed had indicated it through its interim commentaries as well. While fund rate projection is closer to market expectations, CME Fed Watch tool indicates that it is increasingly expecting more. Probability for a rate cut in 2019 has increased to 29% from 14% a month before. Now, further, lower domestic growth expectation is also a reflection of the lower growth estimations for other parts of the world. As a market reaction, dollar index has slumped post Fed's announcement, and US 10-year yield has broken important support levels as well and is at a range last witnessed in December 2017. Now, in this scenario, countries like India may benefit, which has relatively stable growth versus other parts of the world like Eurozone and China. However, investors should continue to keep a close watch at the developments on China, US-China trade talks and Brexit. A worsening of scenarios on these factors can interrupt the recent emerging market fund flow party.